Welcome back to the November update of this series, where we have been using 6 metrics that historically have been a guide to help us assess the markets out there. By the way, if you want weekly updates, I do have a newsletter I put out called The Pulse every weekend. I'll put a link in the description of this video. You can sign up for that. At the last time we updated this video for the month of October, you may recall that all of the major North American markets had been in a decline. If we look at this chart here, we can see what happened during that period. The question at the time was, are we at the start of something? Is this a change, or is this just a blip downward? Well, since then, we can throw that concept of blip out. If we look at the charts today, the Santa rally is in full force, and in the month of November, wow, the TSX was the laggard, up about 3%. We saw the Dow Jones having a really good month, up about 6.3%, and the S&P 500 and the NASDAQ both coming in sort of just shy of the 5% range. If we stretch that line back a year, this is very interesting. We can see here the TSX has been basically flat during that time. In fact, right now it's down a little bit in 1 year number. The NASDAQ obviously having the best time. The Dow Jones Industrial, this is interesting. They're up 5%, but that's pretty much thanks to what happened just back in November. The S&P 500 up about 12% of the year. So despite the feeling of a bull market, I think that's generally what people are feeling these days, only the NASDAQ has been the strong performer out there. And even that's guided by a very few handful of companies. Now, let's look at what's happening today. And I want to start, as I always do, with the yield curve, or the yield curve inversion. I want to start by revisiting this chart here. And this is where history shows that an inverted yield curve often precedes a recession. It turns positive, and then there's a recession. And for those of you who have been following this series, we have been in a position for a while now where we do have inverted yield curves on the two metrics, the two yield curves that I look at in this series here. A couple of things before I go on. First of all, recession, if we do go into recession, and there's some debate about that, it certainly isn't 100% guarantee that we're going to be going there. And even if we do, a recession doesn't guarantee that there's going to be a correction. It just, definitely increases the odds. But this metric helps us look at, are we going to be in a recession? And then if we are, we're going to assume that the markets are going to have a rough go of it. So the odds are higher, but certainly no guarantee there. When we look at last month's chart, we can look at the blue line here, the US 10-year 3-month yield. We look at the orange, the 10-year 2-year. Both were in negative territories, as they have been for many, many months now. But we're starting to narrow that inversion. Well, when we look at it today, there has been a reversal. And in fact, both have slid more into inverted territory. Particularly, we can see here the blue line, the 10-year 3-month. That has had a significant drop back down to be more inverted. Now, what history tells us here is that we are just getting closer to either a recession or a correction. Again, not guaranteed, but that's, the point of here is using history as a guide. The yield curves go negative, then they go positive, and then we see that market correction, at least looking back over history. So last month, my verdict here was no. When I look at this number in and of itself, it's telling me that there is still more pain to come, that we have not seen the worst of things here yet. Today's numbers just confirm that. So I'm staying with the result, my verdict of no in that category. Now, move on now to moving averages, the second metric we look at here. Look at the S&P 500 and its 200-day moving average. You remember with the last update, if we look at the blue line here, that's the S&P 500. The orange line is the 200-day exponential moving average. We can see that the S&P had dipped below the moving average. And the question of the day was, will it drop further or will it recover? Is this just sort of a dip below? Well, today we can pretty much forget about that dip concept. It's been full steam ahead since then. We can see here very strong move above the 200-day moving average. So the question, of course, is can it last? And this takes generally a few months of a cycle. And this has been, I've wavered a little bit on this one because we've seen we've seen originally sort of bouncing around the 200-day moving average. Then we saw a really strong sustained move above, and it was looking like, whoa, okay, maybe we are into more of a bull market here. Maybe we have seen the worst of it. But when I look at it now, I want to see, again, another sustained period of time, not just this one little blip up there. So I'm going to say that for this month, I'm going to stick with my verdict of maybe. And we'll see how that plays out. Now, the third metric I look at is the volatility index, the VIX. The VIX, that measures uncertainty in the markets. And in October, we saw a move up. And do you remember at the time that markets were really falling? So this may have been, I guess you would say, a sign of concern. And my take on this is that we do need to see the VIX move up to confirm that bottom. Well, apparently that's not the case, or apparently the markets don't agree with me, because we've seen that VIX now plummet back to the 13 range. So even lower than it was just a few months ago. So that's really telling me that the markets in general, at least by the measure of the VIX, are comfortable with where the things are right now. Now, as I said last time, I think this has been a bit confusing for me. Last month, my verdict was a cautious yes. I'm saying when I look at this in isolation, and again, just a reminder, these are 6 metrics amongst many out there. So you don't take one of these and make a conclusion based on that. That's why I'm kind of doing an amalgamation of them here. I said maybe this is an exception to the normal cycle. I'm willing to accept that. I'm sticking with a cautious yes for this cycle around here, but I do want some more data to confirm that. So we'll just see what the coming months bring. Now, the fourth metric is the U.S. jobless claims. And in this metric, historically at least, new applications are going to fall before we see a market bottom. We can see by this chart, since April, the number was slowly moving in a positive direction. We want that to go down, but we should actually see something that we should notice, not just a drip, drip, drip. We should see a stronger move. Since the last update, there has been a move back up. In fact, it is far worse than it was before. People are applying for benefits. Layoffs are continuing. The U.S. unemployment rate has gone from 3.4% in April up to the current 3.9%, at least as recently as October. If we look at initial claims, again, October had seen a drop since June. Today, that number is going back up a little bit. In the latest U.S. Department of Labor's news release, they say in that release, in the week ending November 25th, the advanced figure for seasonally adjusted initial claims was 218,000. That is an increase of 7,000 from the previous week's revised level. The 4-week moving average was 220,000, a decrease of 500 from the previous week's revised average. So my interpretation here is I'm watching that moving average. It was down, now back up a little bit, is sort of hovering there. Continuing claims, initial claims, these are up quite a lot, especially that continuing claims number. We can see that. Last month, I had said that maybe because we'd seen some decline there, this may be pointing us in the right direction, but today I'm changing that to no. There's nothing that I'm seeing in the jobs data that is telling me that, yeah, we've seen the worst of it behind us. And so I'm actually going to switch that to a no for this cycle. As always, I just follow the data here and give my interpretation of it. So that's where I'm falling in. Now, the fifth metric is the Baltic Dry Index, the BDI. At the last update, we had seen a slight pullback after a little bit of gains there. Well, since then, we have seen that pullback was pretty short-lived. We've seen a really nice bump up in that number. If we look at the Marine Link November 30th, 2023 article here, we can see the Baltic Dry Bulk Index doubles in November. And generally speaking, there's been a pretty good bump up in the marine traffic there, the marine numbers. So last time when I did this, I said it's a maybe. I'm going to maintain that maybe today. But remember, historically, we want to see a bump up in that, a sustained increase in that BDI number, and then the bottom comes. Then the correction comes, or that happens either coincidentally with the correction or the correction will follow. So I'm giving that a maybe. I'm sort of on the fence a little bit with what BDI is telling me there. Last metric is the PMI, and the latest numbers are in for November. Now, September, we saw 49%. So that was looking better. Then October, that was down to 46.7. Today, no change. We're staying at 46.7%. And when we look at the Institute for Supply Management website, they say the U.S. manufacturing sector contracted in November as the manufacturing PMI registered 46.7%, the same figure recorded in October. We can see that on this chart here. In their commentary, they say this is the 13th month of contraction. And on a longer term chart here, we can see how that slipped back late last year. That has been contracting ever since. So for a little bit of context, I want to look back, and I did this last video as well. I think I want to look back to the early 2000s. And this is just to sort of help get some perspective here. We saw the stocks declining well past the PMI bottom. So you can see by this chart here, we saw the PMI going through the negative or the contraction period. Then following that, we saw the market bottom. So, is history rhyming here. Only time will tell, of course, but this is now the 13th straight month. And as I've said the last few episodes, how can that be good? I don't see that being a positive thing. And I've kind of opined maybe the markets are sort of defying reality here. They're possibly, as we saw earlier in this episode here, a lot of focus on the NASDAQ. The NASDAQ has been making us all feel good. So as far as this metric is concerned, today, maybe I think the markets are defying gravity a little bit. Last month, I said no, and I'm going to stick with that for my verdict for this month. No. So when I look at this in summary, the yield curve is telling me no right now. The moving average is giving me a maybe. The VIX is giving me that cautious yes. Jobless claims, moving that to a no. The Baltic Dry Index maybe, and the PMI no. So we've got one yes, we have three no's, we have two maybes. As always, what do you think? To me, there's still not enough evidence out there to convince me. As always, do not please take this and rely solely on this information. This is just to give you some things to think about as you're performing your own due diligence. A reminder, I do a news segment on this channel every Monday, every Wednesday. You can subscribe and follow me there. We also have our weekly newsletter called The Pulse. It covers the latest trending business topics. I'd like to see, if you'd like to see more of that, again, I will put a link here. You can link to that playlist. As always, I will put a link for our Investing Academy in the description of this video. Thanks so much for watching this video, and we'll see you on this topic next month.